Okay, so like in any job, so if the story would go as, listen, CEO is just another job, manager is just another job. People that don't perform well in the jobs, they get fired and then they can't have any more jobs. Okay, so that's it. So that's enough of a penalty, right? So if the managers perform badly, they will get fired. Okay, and then they will not get another job, and then that's fine. Then we get end of the market cleans up itself. Okay, is that clear?
Yeah.
Now, but here we have a little bit of a problem because so CEO tends to be the last job that you have. So from there, you kind of like retire, okay? So you may really be looking for another job. One, two, we saw on boards regularly hire bad CEOs to begin with. So it's not like the boards are penalizing them. So who's going to fire them? So they're really not getting fired. Okay. So it's going to be a little bit of a difficult trying to find some evidence for this because it basically comes back to the boards that are working and the shareholders are not firing of the CEOs. Okay? So people are trying to see, well, maybe there's some direct ways in which they're penalized by the labor market. Okay? Not so much like firing, but they lose prestige or they lose reputation or something like that. Okay? And this is a paper, which is actually a terrible paper by a guy from Chicago and another one from Harvard. Okay? There's two people who write pathetic papers too. Okay, and then they say, well, let's see if, the CEOs that are underperforming firms get penalized by the market. Okay? And the information that we're going to use is, we know that powerful CEOs get invited to other boards. Okay, so if you're a genius CEO, people like to come to the board, and it's very prestigious to be on the board, and so on and so forth. So CEOs of company A get invited to company B, C, and D to be part of the board. Okay, and that's something that they enjoy because that gives them all this prestige as well. Okay, so the question is, so what we're going to say, the test they're going to do is say, let's see if CEOs of underperforming firms do not get invited to the boards. There we are. So do not get to go to the boards of other companies. Okay, that would be like a penalty. Terrible penalty, but I'm not so sure it's so terrible, but it would be like a penalty to try to see is there any labor market discipline at all. Okay, so this is what they do. So then they say, okay, how do we identify bad performing firms? Well, we saw the evidence of dividends, and we saw that people don't like to cut dividends. So the moment you cut dividends, it must be that hell broke loose, okay? Because you don't like to cut dividends. So a very good proxy for companies in severe financial distress is in fact dividend cuts, okay? Dividend eliminations. So what they find is they find companies that have some dividend reductions. Okay? So there is like about 130 companies that are going through a severe dividend reduction. And then they do some matching, okay, with same kind of company, same size, same industry, blah, 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 but not dividend reduction. Company that is doing fine. Okay? So that's the matching sample, the comparison map. Okay. And then what they do is they look at the percentage of managers who obtain at least one additional directorship in a Fortune 500 company from the dividend reduction announcement to the proxy statement of the third fiscal year. So I announce the dividend, and then I see if you obtained a job in another, a seat on a board of another company for the next 3 years. Is that clear? Okay. So the simple statistics that they do matching regressions and everything that you want. So they look at, the simple statistics say, okay, so we got these 250 CEOs, and let's see if you are, this is the percentage of directors that obtain at least one new directorship, and you see that the comparison managers is about 22%, and these guys are 10%. Okay? So this is basically saying that, the dividend calling managers are not obtaining as many directorships as the other. So then you would claim, okay, so this is kind of evidence that the labor market is working. People are penalizing this. Okay? That the people are penalizing this bad CEO. Does that make sense?
Mm-hmm.
Well, it's all garbage. Okay? So why is it garbage? It's actually bad. Okay? It's a terribly designed experiment.
It's just percentage. Well,
That's okay, it doesn't matter. It's not about the percentages. That, it does say these percentages are different than that one. And, the chi-square test is, is 7. So the percentages are different. So it's something more about the design. Okay?
How are the Fortune 500 companies?
Well, those are the top companies, okay? So these are the Fortune 500 companies are the largest companies, so like the most prestigious ones. So that's an index for prestige, okay? Okay, I'm going to give you 3 tips, okay? And I'm going to give you 2 minutes to decide what you use, okay? Let's see if you get it, okay? Tip number 1, okay? You need to think about supply and demand, okay? So your basic economics, supply and demand, okay? Tip number 2, okay? I'm going to give you 2 tips or 3 tips. I'm going to give you 2 tips, okay? Okay, so it's about supply and demand. And the second tip is this word, obtain. Okay? Have you heard about supply and demand? Okay, so I'll give you 2 minutes, okay? So it's not about the Fortune 500. It's not about that the matching was going wrong and it's the same quantity, the matching done correctly. Okay.
there is very few people who pass out.
How do you think about it? Think about it that you just there's few people that want
Experience.
what?
Experience in managing.
No. These are all CEOs of large companies that I think are in Fortune 500. Oh. So this is a big time when you read papers, okay? Okay, so so are we done? Any ideas? Okay, what is the idea? Okay?
So we were talking about supply and demand. So like there the number of positions and boards are not necessarily like in absolute terms and in temporal terms equal to the amount of managers that I don't know, and they don't get laid off, but
No.
that cut the dividend.
Because these other guys are doing, I think the matching sample is doing great. In fact, we just picked another 120, so we picked 130, and these guys are much larger percentage of them, so think that there's differences in percentage, okay? So there were enough jobs, and even if there were not enough jobs, these guys are getting more. So not about that, okay?
I don't know. Maybe that when there's a company that needs a CEO, they contract with another CEO that goes out of the company.
And we're not finding CEOs, we're finding the job is you're joining the board of another company. Okay, so I'm the CEO of a company, okay, and now I'm joining the board of another company as a board member. Okay, I'm not a manager. So it's not about that, it's not that. It's just joining the board. Okay, yeah. Again?
The idea is how many board members become a pillar?
No, that's the idea. There may not be enough. Okay, no, there's enough. Okay, in fact, there's enough. The thing is, in fact, whatever they were, these guys get it with a much larger proportion. Even if they were only 10, they get it with a much larger proportion. Okay? So it's not about restrictions of quantity of available board membership. Okay. Now, okay. Any other idea? No? Before you destroy your dreams? No? Okay. Fine. So now let's think about what supply and what demand. Okay? So this is the demand for jobs on a board. Okay, so that is CEOs that want to get for board. Okay? And this is the supply of CEOs that want to go to the board. So there's supply and demand. Okay? Now that I gave you the clue, okay, what's going on? Now you can put 1 and 1, so that means that I made 2. Okay? What does the word obtain? What does obtain translate to in a graph of supply and demand?
Demand.
Obtain?
Increasing demand.
No, not obtain. Obtain is what? It's an equilibrium. It's an equilibrium. So this is obtain. Okay? So what these guys are after is they say, listen. Okay, so what we have is supply and demand of CEOs looking for a job in a board. Okay? Obtain means I have this quantity. This is what supply meets demand, right? But now, imagine what you can interpret this. So the way these guys originally interpret this is they say, hey, listen, the companies that are looking, so the demand, that are looking for board members, okay, they look at the dividend card guys, okay, and they say, I don't want them. So the demand goes down, okay? The demand goes down, okay? And that's why we have these guys obtain less directorships, right? So that would be demand is penalizing them. There's less demand for them, okay? But I can get to the same point if, exactly the same point, if instead of demand, supply goes down. So these guys that are the dividend products, for the first time in their lives, they actually have to work. Now they have to actually go to the office and make sure that the company is running and so on and so forth. So they may not want to accept the invitations. Demand is constant, okay? But they refuse the invitations. And I would still there, you can't. So I don't know which one it is, because you told me obtain went down, but that's an equilibrium of 2 curves, right? So this means that, probably it's demand, probably it's supply, but I can tell, in order to be sure that it's demand, that it's penalizing, what would I need to have? As what? A control for supply. Well, yes, how am I going to control the weather? How am I going to control the weather? That's going to be more difficult. We need to have the refusals. So you can have all the invitations, but you need to have the invitations and then the refusals. But that's not what they have. So that then you could say, well, the invitations went down by this amount, and the refusals went down by that amount, then you can benefit supply and demand. Okay? If you want to tell that the market is penalizing, they have to be supply. And what they will need to obtain is they will need to go to each company and ask the company, did you invite these 130 guys? Okay? And the company will need to tell you yes or no. Okay? Because I may have sent the same invitations, but the guys just refuse them. Okay? And that's not what they have. All that they have is this obtain, and that's just correctly. Okay? So that's a terrible paper that never says a lie to do that. Okay? Good. So this is to tell you that there doesn't seem a lot of evidence that the labor market really is working out. Okay? Probably going to be very hard to prove, so we'll move on to that one. And in fact, this is pretty much linked to this. This is where you should draw the graph. Okay. This is pretty much linked to probably the board's not working out and the shareholders not penalizing it off money. Okay, so it's another thing. It's another it's another line of work that has gone nowhere. Okay, but any questions about that? Okay, so now we have very few things left, guys. Okay,
Yeah.
so all we have is we got debt, long dividends, labor market. So all we have is big guys. Okay, big guys left on the table. Okay, there's two kinds of big guys. Okay, that can be part of a corporation. Okay, it's either banks or householders. So the idea being, we're going to go back to this idea. Let's start with banks. The idea here is going to be, the banks, their banks are powerful. Remember debt. When we talk about debt, so this is spin-off of debt. Okay, and we said that the most important thing in debt was senior long-term debt. Okay, so debt is going to be powerful, particularly if it's held by someone that knows the company and can, do the exercise the muscle. Okay, so that's kind of the idea of banks. Okay, banks are important investors. Okay, in many countries around the world. Okay, or they hold large percentage of the claims, and therefore they have the muscle to see if the manager is doing bad. If he does bad, he takes it to bankruptcy. But if he does well and it's not his fault, okay, they don't take him bankrupt because they don't want to kill the goose of the golden egg. They just understand that it's Trump's fault. Okay, Trump is sending the tax to Greenland, so they're not going to just kill, the tobacco firm. Okay, just because of that. Okay, so that's the idea of why banks may be a good control mechanism. Okay, because they have the muscle. Okay, and if they can exercise this muscle by, throwing the firm into bankruptcy when it's the manager's fault, or saving the firm from bankruptcy, that is undertaking short-term lending, like Terra, making it survive because it's Trump's fault. Okay, and we don't want to kill anything because that's what he wants for us. Okay, so this is like a take on that, saying that this is banks are like smart debt, senior long-term debt that is looking at the long term and not just the short term like bond. Okay, for public markets. Is that clear? Now, the key difference with shareholders is that shareholders need to get together, they need to be involved, they need to be informed, and we know that a lot of these shareholders don't really care because they make a very small positions and, they invest their time. Okay? So here is that they don't need concerted action, okay, because the bank can just act like that because it's already there. Okay? Is that clear? So he just decides on his own. He doesn't need to call anybody and ask anybody for permission. Is that clear? Yeah. Okay. So the early literature in the 1990s, okay, the early literature on this in the 1990s is literature that starts to say, okay, so maybe banks are good for corporate governance. They've got a great corporate governance mechanism, okay? And then they say, well, let's start by looking at where banks are powerful. And there's two major countries, okay, so this is where corporate governance has to get global. They say, well, banks are not that powerful in the US, but they're very powerful in Japan or in Germany. Okay? So banks play a major role in Japan and Germany. So in Japan, okay, there's something that is called the main bank system. Have you heard about that? So this is a system that every keiretsu, okay, or every conglomerate in Japan, every keiretsu has a main bank. This main bank holds a lot of the debt of the conglomerate. And all the other banks have agreed that whatever the main bank does, they all follow. And this main bank is sitting on the board of the firm.
Okay. So when you say banks are powerful, is that most of the rest of the companies are issued by banks and not by capital markets?
That's more or less what happens, yes. So in fact, in Japan, until like 15 years ago, they were very, very small bond markets. So there was a lot of regulation against bond markets. Okay? So most of the debt was actually from banks. Okay? So that's where they looked into Japan. Okay? Yeah?
Just like Spain, like it's heavily relying on banks.
Yeah, so the money, in fact, if you look around the world, there's very few markets. So there's very few markets that have stock markets. Okay, like serious stock markets, and there's very, very, very few markets that have serious bond markets. Okay, most of the debt in the world is bank debt. Most of the debt in the world is bank debt. Okay, so this is why we're looking at banks. Okay, so if equity markets are concentrated, bond markets are incredibly concentrated. Okay. So this is that's one of the places where people went, and then they say, well, there's this other paper, there's this paper by Capital and Milton that say, let's see here in Japan, where there's the main bank system, the banks fire managers more. And they do come out with some statistic that says management turnover. You know, you remember the design that we did with the full performance, do you fire the CEO? Okay, so they do kind of the same study, and they see that after poor performance, if the main bank is in the board, they fire a little bit more. So it goes from 6% to about 9%. Okay? So they say, yeah, hooray, banks are protected to the corporate governance mechanism because it goes from 6% to 9%. Okay? In extreme cases. Okay. So that kind of works. Then they went to Germany. Okay? And in Germany, it's kind of like the same thing. So this is the big way from Germany. Okay? So in Germany, it's a little bit of a different system. In Germany, what you have is the banks, there's no main bank system, but the banks own a lot of shares of the bank. Okay? So the banks own about 40 or 50% of the shares of the largest companies in Germany. Okay? 35 or 50%. So they are the large shareholder. Okay? So then people find out in this early evidence, they said that banks, when banks are sitting, and when sitting on the board and hold shares, okay, that improves the company performance more than other blockholders, more than other shareholders. So they find some evidence in the 70s, but not evidence in the 80s, but there's some evidence running around in the middle. So then people say, okay, that may be the case. Okay, and then they go to, there's a couple of papers in the US, and then people go back even to before 1929, and they say when JP Morgan was not only the investment bank, but a commercial bank, when they were in the two positions, actually, JP Morgan created a lot of value, so these companies tended to be a little bit better performed, okay? And then, the guy says, well, banks actually are very important in bankruptcies, so how will the banks help to go bankruptcies, etc. So there's some slight evidence on that, okay? So people are saying, maybe we should forget about the US system, which is capital market center. What we need is to go back to the bank center mechanism because capital markets are just too, just too confused. Investors don't know anything. They're focused on the short-term run. Well, these guys are focused on the long-term run. So the solution is to be focusing on the long-term run and not be flipping, every quarter for profit. Okay? So there's a big literature that starts in the 90s that is the bank center versus the market center system. Okay? So people started internationalizing a little bit the literature but say there's bank center system and market center systems. And remember that in the 1980s, the US is tanking, it's not doing great. Okay? And everybody in Germany is doing great, and Japan is doing great, so people are thinking there's something wrong with the US economy. Capital markets are too short-sighted. We need to move into banks. Okay? Because these are the guys that are really there for the long term. Okay? So the bank sector versus the market sector literature, and it's all of this based on this kind of evidence about yes.
After 2000 crisis, many little banks, small banks, were purchased by big banks.
Big banks, yeah.
And the big banks incorporate such big and was it
Why do you incorporate such?
they were that it is in the world of companies and such as this current.
I'm not necessarily perfectly. So you say that after the financial process, a lot of banks were bankrupt, and then they were bought by other banks.
Yeah. And
JP Morgan is an investment bank, so they were bought by investment banks or they were bought by commercial banks.
I was thinking more commercial banks, but I don't know if in now that the USA, that banks that they put people in the companies, like Germany exists and
But this would be like I buy a bank, okay, so I merge with another bank, or I acquire another bank. But that doesn't mean that I'm going to buy shares of another bank. Okay? So that doesn't mean, there was something I was sort of glass speaker in 1939 that said investment banks cannot have commercial banks because we don't want them to have, both sides of the coin. Okay? So typically banks are restricted in many countries are restricted to having shares in common. Okay? So the financial crisis was a consolidated financial system. Okay? So that's really not going to be changing this idea of they started to buy more shares in the bank. No, that isn't what happened. What is really that's a consolidation of that. The other thing that happened is that investment banks now are allowed to buy commercial shares. Okay? So now JP Morgan has a commercial bank, whatever it is. Okay? And now they get access to the credit, to the deposits of those banks, which is something that was not happening. Okay, so we may go back to this idea about JP Morgan creating value because it's lending as well as placing the securities a lot of okay. Something like a piece of paper that has happened and how good are they in their investments. Okay, but that's
Because that's a great compliment. Like I just imagine
That's the idea.
I'm a bank, I pull the money, and then when it comes to that, so I pull or it does when it comes to repaying or whatever it is, or making new deals, I'm gonna pay my own back, right?
Well, that's right. So that's what many people say. Why do these banks be working for everybody? So here comes the recent evidence of the revisionists. The revisionists have in their mind this idea that says, why do the bank care about the pie and not about his slice? Why would the bank be any different than a large shareholder? Okay? And here comes these are my two favorite papers that killed Japan and then killed Germany. Okay? So here's the Japan, people are saying, yeah, having more CEOs. Now here comes this bad and it's Japan back. Okay? So here's that graph from the Japan paper. So what we have here is the net financing of Japanese physical investment machineries. Okay? And you can see here, first of all, this is physical investment. You can see how Japan is growing like crazy. Okay? So Japan is growing like crazy, and then who's paying for the investment? Okay? Who finances the investment? And then you can see that, until 1991, okay, basically, it's a lot of bank financing. So banks are financing about 30% of all the investment. Okay? So banks are there financing. Great? And then this is the percentage that is bought by internal finance, that's your own bank. Okay. Now, here comes the shock. So Japan is growing like crazy, and then suddenly it stops growing. Okay, so this is the Japanese stagnation, which is still going on today. Okay? So Japan just stagnates. And then, but the country stagnates, and it's not the fault of the firm itself. Okay? So the theory would say, remember here the math says, when it's the fault of the manager, you throw them into bankruptcy. When it's not their fault, you lend them. You help them out. Okay? Mm-hmm. Well, let's see if the banks help them out. So this is a percentage of investment that is financed by banks, and you see how the percentage goes down to 0 and to negative. So the banks are getting out, okay, as quickly as they can. Okay? So there's nothing they don't lend, is they getting out the money back. So the sacking okay?
They were even getting out before the crisis.
But there's no other way up here, so you can see it's a little bit cyclical. So they were getting up here, so there's a little bit of a crisis. This is coincides with the crisis, okay? So it sounds like these guys are not helping you in the short-run crisis, but definitely, in this long-run crisis, they're just like not doing that, okay? So they're like running for the door like maniacs, okay? Because, they just want to finance it, and these firms need to finance all of their financing there. So the bank is not there for you. The bank is going to try to maximize its own slice, and then we'll see what happens with the firm. Okay? Is that clear? Mm-hmm. Any questions? Okay. So that's the and this is important because you might say, well, maybe they run away from very risky firms, okay, but not from the big consolidated firms. When you can see that the runaway is everyone. Okay? So risky firms tend to be small firms. So they're just running away everywhere. You don't see any difference from large, from medium, from small. They're just running away like maniacs. Okay? Is that clear? Fine. So the Japanese banks are not goody-goodies. Okay? Well, maybe the German banks are goody-goodies on the world. Okay? So this is the original paper that says, well, let's look at banks in Germany who own a lot of the shares. In fact, what you observe here is that the top 100 corporations and the top 100 corporations, if you look at the three top banks, they basically own about 45% of the shares. Okay? They're large shareholders. It's pretty clear. Okay? So you would say these larger holders are going to have the incentive to sort of like, boost the size of the pie. Okay? So here comes a revisionist guy. So this is, so this is a revisionist guy, and they say, well, let's see if in the recent evidence, in the 90s and in the 2000s, okay, we observe that banks are really imposing some discipline. Okay? So there's four or five graphs of this. First of all, this is the sample that they use, okay? So they're using, these tiers of data, and you can see, trying to figure out if the bank sits on the dorm, so they're on the dorm. If the bank sits on the board, may look like a dorm, okay, but because they don't do anything. But yeah, you can see that banks are present, most of the time, and they're present in 45%. This is the percent that the bankers own, each individual bankers own, so they're still there, okay? Fine. Now, let's see what they do. Okay? So they're going to be running regressions, controlling for everything that you can dream of. Okay, so the first regression is, okay, let's understand what the bank is getting. Okay? So here what we have is, the effect of bank representation on the board on bank debt. So the key coefficient is here. Okay, so you can see, they're running for a lot of stuff, and they have 11,000 firms. Okay, so you can see if the bank sits on the board, there is much more that you borrow from me. So if I'm sitting on your board, you borrow from me. So that's positive and significant. Whereas this is the statistical significance. Okay, if I'm sitting on the board, you borrow from me. Okay, that's okay. That's fine. Okay, if I'm sitting on the board, okay, you give me the M&A advisor. So if I'm sitting on the board, I'm your advisor. Okay? The probability that I'm your advisor is 70%. Okay? So 30% for Deutsche Bank or 30% for Dresden, 38% for them. Okay? So they're basically, I'm sitting on the board, you eat debt for me, and you give me the business. Okay? Now you would say, what is the TAT? This is the TIT, what's the TAT? Okay? Do they restrain management compensation? No. So in fact, you see that the more bankers you have on the board, okay, the more, you're not going to see percent bankers with equity, you don't see any statistical significant difference. Percent bankers without equity, you don't see a statistical difference. So basically, it's all, okay, a wash. Okay, so they don't cost management wages. Okay, so the bank gets the business. In exchange, I'm not going to cut your wages. Okay, and well, maybe that's okay, but something improved valuation ratio. Okay, so here's stock is Q, remember? And it says, here's the percent of bankers, and notice that what we have here is a negative. Okay, so it says that the more bankers are there, okay, the more negative. Okay, stock is Q is going to be, so it's exactly the opposite way. And even if you look at something like ROA, again, more bankers on the board, more negative performance. So the banks are really doing nothing. They're getting the business, they're shoving the debt into the stomach of the firms, they're getting the business, and they're doing nothing for performance. Okay? And this is the idea that why do bankers need the goodies of the world? Okay? So you can see here, the banks are sacking the firm. So they're not, they're sacking the firm. Okay? Any questions about that? Well, there's not a lot left on the table, okay? So now we go back to maybe bankers, they don't care about the firm because they don't have, which actually doesn't go with the German entrance, but they don't feel the same pain as large shareholders. So what we need is fewer large shareholders, those that are not confusing their debt with their ownership. So maybe the same Grace is the large shareholder. And why would the large shareholder be deciding Grace? So there is this literature that starts saying when we're trying to control managers, everyone needs a large shareholder that has a ton of shares that really wants to monitor. Okay, so the large shareholder is a fantastic monitoring mechanism because the large shareholder, unlike small investors, has an interest in monitoring. Okay, and this is because the large shareholder solves something that is called the free rider problem. Okay, you guys know what the free rider problem is? No? Well, it's a problem of trying to free ride. Okay? So imagine that the structure of the ownership structure of a firm, okay, it's like this. So what I have is I have the manager who owns about 2 to 3% of the firm, a small percentage, and then I have a smaller shareholder. Each owns a little bit of one share. Okay? So that's the ownership structure of the firm. So now, in these structures here, okay, we need to monitor the manager. But who's going to pay the monitoring costs? Imagine you own 10 shares of IBM. Okay, so that's $1,000. Okay? Are you going to be monitoring the firm and trying to call the manager and telling him you should do this, you should do that? Okay? Customer is not going to call. Okay? And so on and so on. So, would you incur in the monitoring costs? Even if you improve the company performance by 50%, okay? So you went from 1,000 euros to 1,500 euros. Wow, 500 euros. Does that pay your monitoring costs? No. So small shareholders free ride or try to free ride on the monitoring done by someone else. But if everybody, this ownership structure, if everybody owns one share or $1,000, all of you, nobody's going to monitor me. I can do whatever I want. Okay? So they don't find it optimal to monitor. They're going to free ride on the monitoring. In the end, this guy is never monitored and he does whatever he wants. Okay? But if now what we have is a large shareholder here, okay, that owns 20% of the firm, okay? Then this guy, imagine owning 20% of IBM. That's billions of dollars, right? So now one can have a bunch of lawyers, a bunch of financiers, and a bunch of people to monitor the firm. So just an idea, okay, I become active probably, and try to monitor the firm and get some benefit because if I have, $100 million, $100 million in shares, okay, then if I increase the performance by 50%, well, that's 50 million more. So that would pay for my money. So this is the idea that the large shareholders may be the solution of the problem. So the early literature says what we need is a large shareholder. Okay, who's going to be breathing down the neck of the guys. Okay, and he's going to monitor them because he has a very big incentive to monitor because he gets a lot of the benefits. Okay? Is that clear?
Yeah.
Fine. So then people say, okay, are there any large investors in the world? And there's basically 3 kinds of large investors. Okay? So the first ones are typically, institutional investors like pension funds. Okay? So these are investors. In fact, some of these funds actually create a reputation as a fund that cares about corporate governance. For example, the CalPERS fund, which is the California Pension Fund, one of the largest funds in the world, pension funds, and they say, we invest in companies that have poor corporate governance, and then we turn them into better corporate governance, and that's how we make it. Okay? For example. Okay? Now, so let's see, maybe that's what we need. Okay? The second ones are mutual funds and activists. So these are people that get a chunk of the firm, and then they become activists, and then they will get, they will get some gains from changing the company. The third ones are when people are becoming like shareholders, like in the old literature they were called raiders. So the one that would come and raid the company and get investment and then take over the company and break it into pieces and make lots of money out. Okay, so this is like massive activist shareholders at that point. So so these are temporary concentrations of ownership to really liberate the value. So that's what takeovers are. Okay? So it says, so the literature says large shareholders may be good because they can organize the takeover, and the takeover is the discipline mechanism. Okay? Is that clear?
Yeah.
Fine. So let's see the actions. So this is all nice and fun, and we're dancing in the 1998 and 1999, and people are thinking the solution to the very basic problem is large shareholders. Okay? And then comes the relations. So let's have the pension funds. Okay? Could they do it? Okay? So this is a graph that shows you the ownership of institutional investors through, through time. Okay? And then you can see that, looking at 80 years, you can see that this, that households used to have, like individuals used to have like 90% of the shares before, but that households are only about, only about a third of ownership. Most of the other ownership is mutual fund, pension funds, other government funds, et cetera, hedge funds, okay? So basically, put into analysis of 2013, this is, there is a graph from last year, so you can see here, if you take a cut at companies in the United States, this is institutional investor ownership, they own about 70% of even the largest firms in the market. So it's all owned by pension funds. So then you would say, if they want, they can get together, they can call the management and do whatever they say. Okay? And then they're going to force the manager to take the policies and improve public health. Is that clear? That's it. Okay. So this is in the United States, okay? But you can see that in other countries, these actually, pension funds are very big. Institutional investors, for example, in Europe, so you can see institutional investors, in a lot of European countries are, equivalent to the size of the economy, okay? Or, 75% of the size of the economy, Spain and so on. So, they're very big. They could do it, okay? Is that clear? Now let's see, do they do it? Okay? Fine. So, here is an early paper that tries to analyze this, okay? So, an early paper that dates from 2015, something like that. So what this paper says is, like I said, let's see if the institutional investors intervene at times of big crises, big government crisis. Okay? So this is the first crisis. This is more like the takeover wave crisis. This is when the conglomerates are falling apart, okay, and the takeovers are taking place. And in this takeover wave, what people are trying to do is to dismantle the takeover protections, like the green paper or the staggered boards and all that, so that the takeover would come. Okay? So the institutional investors are saying, I don't want the takeover to come because the government is running poor. So let's see if we can get rid of the takeover protections. And then you can see that in the light blues, people are trying, what the proposals that institutional investors are doing is precisely taking off the anti-takeover measures, which is getting rid of the classified board, like the staggered board that we talked about in class, or eliminate poison pills, or get early voting. These are the major things that people are doing. Okay? Board-related measures. Okay? Very few, a little bit of executive compensation, but not a lot.
Okay, I think that large shareholders are
The institutional investors.
the institutional investors, and they are promoting the takeover.
They want to have a takeover, yes.
Get rid of or benefits.
You get have a more management. So the companies are tanking, these conglomerates are falling apart. So this is the age of deconglomeration in the United States. And more or less the same thing happened in 2010 in Europe. Okay? It's the age of conglomerates breaking apart. In 2010s, in Europe, in Europe it's in 2010s, and in emerging markets in the 2010s. Yeah, more or less. Because barriers are going down, or Trump puts them up again, but barriers are going down, and competition gets international competition gets stronger, and then people cannot afford an inefficient conglomerate. Okay? So in the United States, the conglomerates are very inefficient. And we're going to talk about this more when we talk about M&A. Okay? So there's a large deconglomeration wave. So people are getting bought out at large premiums. Remember, when somebody takes you over, they don't buy you at market price. They buy you at premiums, 40% premiums. So institutional investors are saying, well, it's not bad, it's I'm worth 100, if you pay 140, that's good. So people are trying to get rid of the anti-takeover mechanisms to allow the raider to come in. Okay? And you can see that these are kind of these measures that are happening. Now, the second major episode there is the executive compensation crisis. Okay, so that happens in the corporate governance crisis in 2001, 2005. So there, what institutional investors are proposing is changes in executive compensation or more board representation. So this is more or less what they're proposing. Okay? So it sounds like this graph is saying, hey, these guys are not bad. Okay? That's a percentage of all the corporate proposals, governance proposals. You know, the guys are asking for the right proposals here and for the right proposals here. Okay? Now, you put them on the floor, but do you vote them? Okay? In order to pass something, you need to have at least majority. Okay? So this is the amount of votes on the governance proposals that they make. So they put it on the board and then they don't pass anything. Okay? So basically, in the light blue, these were the main things that they wanted. None of them passed. Okay? This is on average they don't pass. Okay? But, you know, and in the other one, this was the main thing. In 2001, 2005, this was the main thing. It doesn't pass. The thing that passes is what it's not a problem at that point anymore. So it sounds like the things that pass are the easy things that manager doesn't care about, and the things that managers do care about, they don't pass. They don't vote them again. Okay? So that's a little bit like sort of like the early years of that. Okay. Is this clear or not? So it sounds to me like this is very smelly. Okay? It doesn't really, it sounds like they're not really coordinating well together or something is going on. And then you come this paper which I love. Okay? So this is a paper of these guys which have very detailed data. And now they're going to focus, okay, on mutual funds. So this mutual fund is firms that own shares of many companies, and you would expect it to be influential, you know, for the management and very big corporate fund. Okay, does that make sense? Okay. So these guys have this fantastic data because they know which mutual funds have shares of which companies, and then they go to the company. Let's say that mutual fund A has shares of company X. Then they go to company X and ask company X, do you have a contract with the mutual fund A? Okay, that is, are you paying something to the mutual fund? Okay, so they find the contracts that they have. And in fact, mutual funds have contracts with firms. Okay, so the mutual funds not only they own shares, but they can be the contract administrator of a firm, they can be the record keepers, the investment manager, the trustee, or the investment advisor. Okay? So I own your shares and you give me some jobs. Okay? Just like the banks give me them a job. Okay? And so they know the contracts and they know how much money they're getting paid for each contract, which is beautiful. Okay? So you know this is the amount of money they're getting paid, direct and indirect compensation, and this is the amount of investment that they have. Okay? This is the total compensation that they have. Is that clear? Yeah. So now we have the two ends. Okay? We have the tip and the top. Okay? So now you're going to see how do they vote, you know, when they vote, when there's a proposal. Okay? So first of all, you know, this is their voting behavior. When management says, let's vote yes, that's the recommendation, 78% of the times they vote yes. When the manager says, let's vote yes, and it's a management proposal, so I made this proposal, well, guys, vote for it, okay? 100% of the times they vote yes, okay? But when it's a shareholder proposal, they kind of don't, okay? And it's just like, you know, oh, if the shareholder's proposing, oh, no, I understand. You know, it's fine. So that starts to be a little bit smelly. Okay, so then, but here comes my favorite set of regressions. Okay, so then, is it because you have another proposal? Okay, maybe because shareholders are stupid and they make stupid proposals, so who's going to vote for stupid proposals? Right, the manager is smart, so I vote for the smart proposals. But now let's see if it depends on the money that I'm paying. Okay, so here comes these regressions. Okay, so these are all the proposals of a decade. Okay. And the economic regulations, you know, with firms with effects, you know, firm, you know, what you can think of, you know, X of its effects, you know, anything you want, okay? So 170,000 observations, okay? So we're going to see if on all proposals, okay, if you pay me more, this is a lot of compensation, I vote more with you. If I have a business contract with you, I vote more with you, okay? So basically it depends on not only on the qualities that I have with you, but also on the contract that I have with you. Okay? So it sounds like these guys are pretty much with an agency contract, right? Because the manager told them to vote because they gave them the contract. And I guess probably the two, but most of the time because are C. Okay? So year zero, okay, what we're measuring here is year zero is the year where I get the contract. So the year where the mutual fund gets the contract from this firm. Okay? And this is the percentage of votes with management. And you can see that before you give me the contract, I'm voting less with you. You give me the contract, I vote more with you. And the next year I vote even more with you. So that's very sufficient. Okay? And here's even that has the opposite. If you take the contract away from me, so I was voting with you like this, you kick me out, I vote less. Next year I vote even less. Okay? This is like beautiful. So it kind of like says these large shareholders also have their own slices that they want to maximize, and that kind of maximizes their own slice. Okay? Any questions about this? No? Okay. So this is another even beautiful one. Okay? So this is you're gonna like this. Okay. So this is what we have is this is what this is saying is like when does management really call you to vote? Okay. So this is this is when it's a management proposal. Okay. And you can see that this is the one you're compensated, you kind of vote with it. Okay. But this is versus a shareholder proposal. And this is a management proposal which is contingent, which is potential. That is, there are some proposals that are debated, okay? That your shareholders are proving some opposition. And that's exactly where they call you to vote. Okay? Because when I have trouble, that's how I'm going to call you, and then you go much trouble. Fine. Great. Okay. So let's finish large shareholders, okay? And then we take a little break about the costs. Okay. So it sounds like we're not getting a lot of benefits from that. Okay. But now there's a revival of this that says, well, in the new age, okay, now there seems to be large shareholders that come in like activist investors. Okay. So you must have heard now these activist investors, a guy that comes in, it's active, and then tries to get some money and it tries to improve corporate governance. Okay, and then maybe he comes out, maybe he stays, or that increases the value of the fund. So people are now very excited, since then 2010s and in the 2020s, people are very excited about these activist investors because they may be the saviors of the world. Okay, and in fact, people have since in the last decade or so, people have actually helped people, CEOs, fought for breaks of companies, gotten board seats, organized, structures and consolidation. So maybe these are the saviors of the world now. Okay? So maybe this is a revival of the larger golden power. Okay? So when we come back to break, we're going to see if these guys are really working out. Okay? If they really are doing something else that is better, because markets have learned probably. We have 30 years of experience. Many markets have learned. These guys are doing something a little better. Okay? Any questions? You want to take a break?
Yeah.
Okay. So let's say a 12-minute break. Nobody wants to have a meeting.
Yeah, 10, 12.
10? Okay, let's take 12, 13. Okay, so let's go back to 40. Is that okay?
40? Okay.
40.
So if you said it,
My time
It's 5:23.
It's 5:23. Oh, no, so let's go back to 5:35. Okay, 535, yeah.
Okay, 535. Great.
Okay, 536, okay? Outside of 536, okay?
Great.
And then I'll finish this stuff, for sure. Let's get up and ready to do
I know it's this week. No, the point is that we don't even know if it was good or not. We think it was
Okay, guys.
Yeah, my rule is not.
Okay, any questions so far? Yeah.
So the large shareholders, I know we haven't mentioned this, but I mean, for family-owned businesses or like soccer business, like that's the same as institutional fund, right? You have one guy who's gonna vote whatever they want for the firm.
Yeah, so we're gonna see, so this is what's coming next. Here we're still thinking that the large shareholder is kind of going to be this kind of independent guy, or independent from management, okay? And he comes to challenge management, okay? So that's kind of the idea so far, okay? And obviously when you get to family firms, or if you guys, and we're gonna talk in the last part of the agenda today, we're gonna talk about this corporate ownership paper, okay? And then we're gonna see that the large shareholder is actually going to be their problem, okay? It's the guy that organizes the whole thing. So that's what we're gonna talk about next, okay? So here we still have, this setup in which the activist is coming in, he masses up a little bit of muscle, and he buys 5, 7, or 10% of the firm, and then he kind of like, tries to attack companies and impose good governance, okay? So, in fact, this is kind of the idea, for example, even in Europe. So there's been in the last 8 to 10 years, people have started to say, hey, activists are growing, and they're not only growing in the US, but they're growing also in continental Europe. You can see even in Germany, we see, activists go after German industrial icon so that they split. Companies are, these guys are buying into Europe and so on and so forth. So this is an example of more what we're expecting from an activist, okay? So I don't know if you heard about these guys. Okay, so this is a company that is called SoftBank. Have you heard about SoftBank?
SoftBank?
So SoftBank is the largest venture capitalist fund in the world.
In Japan?
In Japan.
Yeah,
okay?
I know this.
So they own about $100 billion in assets. Okay, so they have most of about $100 billion. In fact, when Trump just won election last year around, he said, "Who's going to invest in America?" Mr. SoftBank was there. Okay, so Mr. SoftBank was there and says, they're going to be one of the 2 or 3 guys, the Oracle guy, and the SoftBank, that we're going to be investing in America. Okay, so. But SoftBank has been, for the last few years, has been having some problems. Okay, so in fact, okay, if you look at stocks, the stock performance of SoftBank, okay, so in 2019, 2020, so it's kind of like a slided back quite a bit, and the big chunk here is that, this is what people call the SoftBank discount. So if you if you take the shares that are thinly traded of SoftBank, because there's only one security that's traded, okay? And you see how much it's worth in the market, they're worth about 100. But if you actually put here their assets that they own, okay, these guys should be worth about 220. Just, they have a stake, they made it big because they actually bought 25% of Alibaba, okay, at the beginning. So Alibaba itself, the shares that they own of Alibaba, they're worth 150. Yet the market thinks that SoftBank is only worth 100. So this is kind of like incoherent, right? Because it's really worth 250. If you just liquidate what you own, you will get 220, but the market thinks this guy is 100. So this is, people say it's because we believe that these guys are going to waste the money. Okay, so this is the guys are wasting the money. It's to a very large tune of wasting money, right? So they're wasting about 60% of the money. Okay, and so there's guys, there's an investor fund that is called Elliott Fund, which is one of the most active, activist investors today. Okay, so he comes in and he buys some shares of SoftBank and now starts to put some pressure on SoftBank. Okay, so starts saying, I want you to buy back 20 billion worth of my stock because it's trading at 60% discount. And how are you going to buy it? Well, sell some stuff in Alibaba and then just buy us back. Okay, and Elliot, says, I want to change the investment policy in the firm, and I want you to install better corporate governance. Okay, so this is what Elliott management is saying. So let me show you a little bit of the report of what they say. Okay. So what we have here, where was my thingy? No, it was not here. It's here, okay?
Run by Paul Singer has taken.
So here we are. So this is like a classic activist campaign, okay?
Elliott Management, run by Paul Singer, has taken a stake in Japanese investment conglomerate SoftBank. Now, according to the Wall Street Journal, that particular size stake is worth about $2.5 billion. But we do have a statement from Elliott Management, the activist hedge fund taking that stake in SoftBank. They say, quote, Elliott's substantial investment in SoftBank Group reflects its strong conviction that the market significantly undervalues SoftBank's portfolio of assets. Elliott has engaged privately with SoftBank's leadership and is working constructively on solutions to help SoftBank materially and sustainably reduce its discount to intrinsic value. Now, that particular news has put shares of a thinly traded depository receipt for SoftBank in Japan that's traded in the U.S. to its session highs. As you can see, they're up almost 10% right now. We'll continue to follow this particular story, but this is a big deal. SoftBank coming under a lot of fire from some recent investments, namely Kelly Tyler WeWork most recently. We'll see if this particular move has anything to do with that, guys. Back over to you.
Don, that's exactly what I was going to ask. I mean, how much does SoftBank, the company, struggle based on those investments going poorly?
So it's interesting because according to the Journal and Dow Jones, part of that particular move here is because Elliott is urging SoftBank to buy back shares, also to make governance improvements, amidst other things. So you wonder whether or not the governance improvements and some of those other requests that are being made have to do with some of the investments that they have been making. If so, this is a fairly substantial move, and Elliott, of course, a very high-profile activist investor, and $2.5 billion. While SoftBank is a very large company, it's not a small endeavor to raise $2.5 billion and invest into a company like this. So a very big deal. It is moving the shares, guys, and that's the reason why we're kind of piling it.
I guess maybe it's too early to draw conclusions because we don't know what SoftBank. I don't believe I heard you say anything about SoftBank's response to this, and it's the middle of the night over there, by the way. But at any rate, is it too early to say that this is, quote, something less than a welcome embrace of SoftBank?
Well, it's interesting. You're right. We have reached out to SoftBank, but this is, of course, as you pointed out, outside of normal business hours in Japan for SoftBank and its company out there. As we take a look at the size stake that we were talking about, Elliott is making it sound like these are friendly discussions for the time being. At least
Right.
they're professional, right? That they are engaging, SoftBank is working with them. The statement basically says that they met privately with that leadership, they are working, and they use the word constructively. So at this stage right now, it appears as though, according to Elliott Management's statement in this whole process, that this is a fairly amicable relationship for the time being. But activist hedge funds always have a way of becoming even more activist if they don't get their way. At this stage right now, it's too early to tell.
Okay. So that's kind of the story. Okay. So this is like the typical activist campaign that's becoming more and more frequent. Okay. This is what you hear about activist shareholders. These are going to be the guys that are kind of like doing this now. So this is an activist that goes in there, buys, and hopes to boost the price. So here's another type of activist. Okay. So here's another guy that actually kind of does the opposite. I don't know if you've heard this story, okay? So it's just a couple of years ago, and it's still unrolling, okay? This is the Adani conglomerate in India, okay? And so it's one of the largest, if not the largest conglomerate in India, and one of the third largest conglomerates in the world, okay? So he's basically, in construction and, in many things, apparently a lot of with government contracts, okay? So Mr. Adani's fortune is about $140 billion, okay? And here comes these guys that are a fund that is called the Hindenburg Fund, okay? So what these guys do is they have a research unit, which is called Hindenburg Research, and they analyze companies, and they figure out if there's something bad about the companies in their governance, okay? Then they issue a report, okay? And then the stock prices collapse because they issue the report of the bad stuff that they're doing. But before that, they sell short the company. Okay, so they're playing on the other side. So they do their report. Okay, they sell short the stocks of the company, and then they release the report and the market collapses. Okay, so you can see here. Okay, this is when they release the report. Okay, this is the Adani, this is what they release the report, and you can see how the price has just basically collapsed. So what did the report say? This is how Adani, grew. The report basically says that, so the report is called the Adani Group, how the world's third richest man is pulling the largest con in corporate history. Okay, it says, it alleges that share prices have been artificially inflated. It describes a complex edifice so that 7 Indian listed companies, okay, are in the middle of 578 subsidiaries, okay, and these companies engage in related party transactions. There's a complex system with multiple companies, many in foreign jurisdictions, which have no obvious signs of operations, and they're trying to manipulate the listed firm stock prices and shift money onto their own balance sheets. Okay, so like related party transactions, like the ones that we saw at the beginning of the course, right? So they release a report and then boom. So maybe not all activists are that nice to shareholders, okay? Because they don't seem to be really caring about the little shareholders of the group, right? They're sort of like they care about their stake on the firm. So this Sarstopoulos says, this is the classic campaign of the goody-goody activists, but this is the classic campaign of the not-so-goody-goody activists, okay? So we need to think about these guys, okay? So let's start thinking about these guys. What can these guys, what the activists do, okay? So first of all, I want to show you that in fact, this is a phenomenon that has been growing. Mm-hmm. It started, it was smallish, okay, and it was been growing. You see over to 2014, it's been growing, okay, and it just keeps on growing and growing and growing. This is the number of activist campaigns that we have observed. You can see how activists were very small, but then they became, an activist campaign is an action that they're taking. So you see how it has really grown a lot. This is campaigns in the United States, okay? These are you can see that most of these guys, these are the top activist investors just a couple of years ago. This is Elliott, by the way. This is Mr. Elliott, the one that went into SoftBank, okay? And you can see this is the companies that are subjected to their demand. So you can see that they have several companies under the bucket, and this is the amount of money that they put into the pocket. So this is growing. It's a fact that it's growing. Now the question is going to be, is this growth is just exogenous? Okay, it is like these good guys are coming in, Okay, and that's question one. Are they just coming in and revolutionizing corporate governance, or does it happen in other places more than in some places more than others? So that's going to be one of our questions first. Okay, and the second question is going to be, in the end, are they increasing the size of the pie, or are they maximizing the size of the pie? Okay, so that's again we're going to do that now. So first, start with the first part of the question: where are the activists? Well, this is the places which have more activists, okay? So you look at the United States, a lot of the activism is in the United States, some of it in Europe. In fact, the one that's in Europe is in Britain, okay, a lot of it. Then there's Hong Kong, there's a little bit of Japan, and then Canada, okay? So look at all of these top places, okay? What do they have in common? They tend to be common law countries, okay, in general, okay? So they tend to be common law countries. And what happens in common law? There is high K.
Yeah, high protection. Yeah.
So so you can see that the activist, in order to be able to do something, first needs to have some tools to do something.
Yeah.
Okay? So, this is where the activists are happening. If you just eyeball, most of the activist campaigns are in common law countries. Because you need to have some K to be able to get there and demand for something. If I have no investor protection, I'm going to get in and I'm going to call and people are going to say, get out of here, okay, hang up, okay? So this starts to say that the market for activism, just like the market for takeovers, it's kind of endogenous. It needs some K, okay? It needs some investor protection, okay? So that's the first part of it, okay? The second part of what I talk about is like, what is it that they do in the end, okay? And do they do good for the firm, okay? So, first of all, what kinds of campaigns do they mount, okay? A lot of it is going to be related to board activism. All of this board activism means that getting seats on the board, okay? So this is about getting seats on the board. The second thing is about M&A, either buying or selling something. So they want the firm either to sell something or to buy something, okay? Maybe to sell because they don't extract the value from the asset, or to buy something so that they can put it in operation. You can see here, for example, the type of M&A activism. A lot of it is pushing for sale or opposing some merger or getting to some space, some asset restructure. Okay. Now let me just tell you a little bit of a story about how a campaign. We saw the Elliott campaign. This is how a campaign can actually go bad for these guys, okay? So this is a very famous, activist episode. This is Apple, your phones, okay? And this is Carl Icahn. Have you heard about Carl Icahn? Okay, he's one of these large activist shareholders, okay? So here he was number 2 here, okay? He was actually, okay, one of the big raiders of the 1980s and 1990s, okay? He's a friend of Trump too, okay? So he's helping him to fix financial regulation, like he's not conflicted, okay? And so Carl Icahn, buys a few $1 billion in $5 billion in Apple. And he does that because Apple is sitting on cash, okay? About $150 billion in cash that it's not using. So if you want to identify a company that is infected with agency, you find the cash. So companies that have lots of cash are likely targets of infected with agency because they're just misusing the cash and not doing that investors. Okay, so he buys $5 billion of Apple. Okay, and then tries to start working with Apple and says, "Hey, listen, I had a cordial meeting." So he's actually the one that taught Trump how to tweet, okay? So he tweets, "Hey, I had a great dinner with Tim." Tim is the CEO of Apple, and Tim Cook. Last night, we pushed very hard for $150 billion buyback. That is, give me the cash and put it in my pockets, buy back shares. We decided to continue the dialogue in about 3 weeks, okay? In the meantime, Tim starts rallying up the other shareholders and the institutional investors, the ones that always vote with you, okay? And he starts telling them, in particular these guys which are institutional shareholder services, this is an institute which is supposed to give advice to institutional investors on how to vote. Apparently, they don't give very good advice. They always tell vote with management. Okay, so he convinces this ISS that Carl Icahn is just a trader that is coming in for the short run. He doesn't really care about Apple. So ISS says, you know, I advise to the institutional investors not to vote with Carl Icahn and to vote with Apple. Okay? So then he writes a letter and gives this Barbarian at the Gates style. Barbarian at the Gates is the book about the takeover of Argentina Disco. Have you guys heard about that? Did I tell you about this ever? This is of the largest takeover ever. He was the one behind the largest takeover in history. Okay? This is when they were taking over, what is it? The name slipped out. But Argentina Nabisco, I just said it. They were taking over Argentina Nabisco, okay? Carl Icahn was there. And then, you know, so, and then he writes back and says, listen, okay, I talked to Tim, he fooled me, he started talking to these guys in the meantime, they all colluded against me, and nobody's gonna vote for anything. We have got reduced it from 150 to 50, and not even that, you know, I'm just selling. So he sells. Okay? So he sells, you know, he goes back crying. Okay? So to tell you that it's risky to be an activist. The success is about less than 50%. Okay? So you can, you know, in order to be an activist, you need to be a little bit careful because, you know, success is not guaranteed. So there is some risk. So if there is some risk, the idea that they're only going to do it for the good of everybody else starts to sound a little iffy. Because who's going to compensate that risk? Okay? You know, you want to do something good for you, you know, put some money in my pocket. That's what the markets would say. Okay? Now, the way to look at that is a little bit about, you know, so let's look at the success rate in general. We said that this is success rate in several activities, okay, in general. Let's look at success rates in getting board seats, which are 2/3 of the activist campaigns, okay? So if you really look at here, okay, you can see that the success rate, again, is kind of like a little bit like half. Either they're settled, or they're sold to a vote, okay? And in fact, you know, this is some activists can face in something that is called getting board seats, which is something that is called proxy voting, okay? Have you guys heard about the proxy vote before?
No.
So proxy voting is, imagine that I dislike the management team. So now I'm going to go and propose another management team. And then the two management teams go into a contest in a vote. Okay? So either the incumbent management wins or the new team that is proposed wins. Okay? If you look at here, the probability that you win and you win control throughout last 30 years is about 40%. And it's sort of like it matches what happens more or less, in the last 3 years. So you can see here, the dissident winning, the management winning, okay, and then some partial stuff. Okay? Now, are markets happy when they win? Yes. So the moment they announce the proxy fight, stock prices go up 5%. If they win, okay, they get another 2.5. If they lose whatever they had. Okay, so we're going back to zero. So it sounds like the markets like them, okay? They react positively, but it's very risky. Again, it's 40 to 50%. So the question is, who's going to compensate these guys, okay? Now, do they actually bring better governance? Remember we said that banks didn't bring better prices and things of that nature? So this is some casual graph from the early, when the economist was very excited about activists, okay? And they said, listen, if you look at the performance of companies where activists went, they seem to be outperforming the other ones. So maybe these are the new supermans of the world, okay? And they're gonna save us all from this bad corporate governance. But here comes now the revisionist evidence, so from more recent papers, okay? So what we have here is, here we have ROE and ROA, and this is years before the activist campaign. So it sounds like, the companies are doing good. Then 1 year before there's a year where they collapse, and then the campaign takes place, and then they recover somehow. Okay, a little bit more in ROE, not so much in ROA. Okay? So now let's analyze, this in detail. So this paper then analyzes this in a lot of detail. So what they do is they look at was there an activism or not. So you can notice they have here, about 5,000 activist campaigns. Okay? So they're looking at is there activism at all or not. So that is the only variable at the top. Okay? And then there is the type of activism that there is. So there is the activist board control, board representation, asset sales, okay? So what comes out of this, okay? If the activists are good for the firm, what would we expect to find here? A positive number or a negative number? A positive number. Sounds like it's negative, okay? So it doesn't seem that the performance is really going up quite a bit, okay? And in fact, the type of activism, is sort of like, in fact, if it's more so it seems to be negative, double negative. The only one that more or less recovers is this one when they get some board representation. That's a 0, okay? But besides that, we don't see very much that it's happening. So are they leaving? So that was ROE, that was ROA, I'm sorry. Controlling for company characteristics, okay? It seems like these guys are not really doing much, okay? So that casts some doubt to these activists. This is the most recent evidence, okay? So what else can they do? Okay, so they can go wild, okay? So not only they can try to get seats on the board, the most aggressive thing is that they say they can come and take over the company, okay? So if that didn't work, maybe they come and take over the company just like they did before, and that imposes some precedent. So this is why people say that the market for corporate control or the takeovers, which is managed by a large shareholder, may be the solution to the agency problems. So what do we observe on this? So we observe the following. We see that when there's a large shareholder, okay, and there's going to be a takeover, okay, a shareholder comes in and takeover, we see that stock prices rise at the takeover, okay, so people think it's good, okay, and this is why institutional investors want to lower down the takeover barriers, and we observe that the targets tend to be poorly run because they have low Tobin skews, okay, and these guys fire management more, so that's more or less what is happening, and you can see that where there's a turnover, the standard turnover is when people get, just quit, and you can see that takeovers fire a little more. So you would say, well, takeovers may work. Okay, so let's see more or less what the shareholders bring, okay? So now what we have here is this period, okay? This is a period where, there's a couple of periods where there is some corporate governance crisis like we said before, okay? And let's try to see if, companies where there is large shareholders tend to do better. So this is the probability of a management getting fired, okay? So what we do observe is that in some regressions, the probability of the large of when there's a large shareholder, the manager might get fired. Okay? So, but that's about it, more or less. Do they increase performance? Not at all. Okay? And here we come to the last part. Okay? Why don't they increase performance after the takeover? Okay? And why don't they do takeovers all the time? Right? So here's the 4 reasons why you cannot, when doing takeovers, is very difficult. First, okay, doing takeover means that there's lots of shares trading and I can buy them, right? I cannot take over a company that Mr. Wallenberg owns where he has 60% of the shares. So there needs to be that control is for sale, right? Control of the company is for sale, right? If you try to take over a Wallenberg company, okay, in Sweden, okay, and Mr. Wallenberg sits on 60% of the shares, can you take it over? No. So it basically requires a very liquid market. Which countries have very liquid markets? High K or low K? High K have more liquid markets because they have more shareholders or more spread shares. So already, the existence of the activist is endogenous to K, and the action of the activist is also going to be endogenous to K. Okay? So that's the first requirement. So takeovers, rarely happen in countries with very low investor protection. Okay, so in fact, there was a joke about, a decade ago, people were saying, what's a Latin American takeover? It's somebody buying 5% of the shares, okay? So that's a takeover because that's all they could muscle, okay? That's all they could do, okay? So this is gonna be a very difficult tool to solve agency problems, okay? Second of all, they're also very expensive, just like Mr. Carl Icahn and Apple. He put $5 billion and then he got kicked out. These things are very, very expensive, okay? And they can be very expensive for many reasons, okay? They can be very expensive because, let me go back to this one, okay? Because you need to put up a lot of money and prices still go up, okay? So let me give you an example of a very expensive one. There's a company that's called Mittal Steel, which is the second largest steel company in the world. It belongs to a guy from India, Mittal, okay? So they're trying to take over a company which is called Aceror, which is kind of a half-state-run steel company in Europe, which has assets in Luxembourg, in Belgium, and in France. Okay, so it's a steel company, contaminated with government ownership. So and it's incredibly inefficient. So Mr. Mittal wants to take it over. So he announces a price of 20 per share. And then the board just goes crazy and nuts, and then they say, well, no, we're not going to accept that, because if he comes, okay, from this underdeveloped country where there's no respect for corporate governance, okay, he comes and wants to buy us, but he's going to destroy us, he's going to tear us into pieces. And then Luxembourg is panicking out because half of the people work in the European Union and the other half working as a. So he's going to fire everybody in Luxembourg, right? So they're panicking, and then they start trying to block the acquisition, okay? Just so they then the price, while that is happening, the price keeps going up, and up. So this guy is putting more and more and more money on the table. So you need to be able to withstand the economics of it. And second, you need to be able to stand the politics of it, okay? Can you withhold the Luxembourg government and so on and so forth? I mean, there are other examples where you need to be able to restrain this. For example, U.S. authorities sue to block the JetBlue takeover because they think it's going to be more monopoly. Okay, Europe, the Germans block Chinese stakes into chip makers because they don't want the Chinese to have the German chip makers. Okay, or the British government blocks the takeover of semiconductors because the last thing that they want to do is to have the Chinese takeovers. Okay. So these are very, on top of you need a high K, you also need to be able to withstand all of the costs, okay? And then finally, and we're going to talk about this when we talk about mergers and acquisitions, okay? The acquisitions can actually be an increase of agency costs, okay? There was a bad guy. I take over the bad guy, but why would it be the good guy? Why would I just take all the cash flows and put them in my pocket? Okay? In fact, the way I take over the company might be with, paying with somebody else's money, which is not my money. And therefore, I can exploit it anymore. So this is going to be something very important that we look at when we do M&A. Okay? Good. Any questions? So the large shareholders, so we saw this list of large shareholders, and it sounds like these large shareholders are not really doing that much. They have some benefits, they do come and they do hire managers, but they're probably not doing a lot. And the big question is why? Okay? Why are they not doing that much? So now we're going to explore, for the last half an hour, we're going to explore these costs that the large shareholders bring. Okay?
Okay.
So what would be the costs? So we were already saying, if you want the activist to come in, he's taking a big risk and a big position. So the first cost is that he loses benefits from diversification of his portfolio, because now I'm going to have $5 billion on my portfolio locked into Apple. So I'm under diversifying my portfolio, plus my costs of mounting the action. Somebody needs to pay me for that. Okay? Second, okay, who says that the new guy is gonna be, the monitor is gonna not care about himself, just like we saw with the activists and so on. Maybe what the guy wants is to get green mail. Okay? So now that I have the stake, pay me more and then I walk away. Okay? Or maybe he wants something quick and get the money and just leave. This is why the performance may not go up. Okay? So that's the second cost. Third, he may actually collude with the controlling group and expropriate the other ones. Why would you imagine that I get here and then I collude with the guy and then we all together exploit the rest? Why wouldn't I do that? Okay? And then fourth, okay, who watches him? Okay, which is kind of the same thing. And particularly, who watches him when in fact him or her, to be politically correct, okay, is the same guy. So imagine that I am the large shareholder and I'm also the manager.
Mm-hmm.
So then who's going to watch me? Nobody. Okay? Yes, go ahead.
Number one, can you explain again? The institution.
I'm putting $5 billion in one company. So the theory, portfolio theory would tell me that I have to have a diversified portfolio. So if now I'm concentrating in the stock, okay, I'm holding too much risk of this guy, and this is a lot of idiosyncratic risk, non-diversifiable risk. So you need to kind of compensate me for the risk that I'm taking, because something may go bad at this point, that who's going to compensate? Okay, so that's kind of the idea. So that's probably why they come in and they want to get something out. Okay, so let's see. Now we're going to explore this part. Okay, so we're going to try to explore this part, and then we're going to see, is it the case that what we have, in fact, and this is what we're going to see, do we have firms that look like this, okay, which we're going to call these firms family control firms or shareholder control firms, or do we have firms in the world that look like this? This is what is called a widely held. This is a widely held firm, and this is a family firm. Okay? Now, all of the early generation that we've been working on governance up until the 2000s and 2005, we're thinking that this is how the world looks like. So the battery of governance tools that we're engaging with are these tools to combat this kind of firm, this kind of governance arrangement. Is that clear? And now, in the 2000s, people started figuring out that the world actually looks like this. Okay? That these dispersed share owners, okay, with a manager which is small and they can, engage in some kind of agency problems, it's really something like this, okay? Where he's the large shareholder and the manager at the same time, okay? And that creates, this is another kind of animal, and this creates a very big disruption in the medicine you prescribe to cure the patient, okay? Because this patient requires some kind of medicine and this patient requires other kind of medicine, okay? So, let me show you the evidence that the world looks like this. So around 2003, 2005, people start saying, this doesn't really look like reality. Where does this idea come from? Well, it came from a very famous book which was called Burley and Means, which was written 100 years ago, or 80, at that point it's 70 years ago. And, they go and measure the ownership of US firms in the 1930s, okay? Ownership is the most secret thing in the world, because nobody wants to know, nobody wants to tell what they own, because they fear governments, taxes, kidnappings, and all of what you think about. So people want to keep ownership very secret, okay? And so for 70 years or something, ownership of firms has been very secretive, okay? Until in the 1990s and the 2000s, people started requiring disclosure of ownership, okay? So this is the only real book that we had at that point, with massive amount of work. And what these guys did is they looked at who were the first owners of the firm, and they figured out that the firm was typically owned by, so here's the firm, and it was owned by Paul, okay, and then it was owned by Mary, and 1,000 more shareholders, like this, and here was the manager, with 2 or 3%. okay? So it looked like that. So they discovered the humans around here, okay? Is that clear?
Yeah.
Now, this has been completely wiped out, okay? So in the 2000s, people start measuring ownership because they start figuring out we need to do a better job in finding out who owns things, okay? So now this idea that we live in a world like this, even in the United States, is wrong. In fact, the world that we live in, okay, is that, you know, even in the United States, even among the largest firms, there is a concentration of ownership, much bigger than in the 30s. And outside of the US, the concentration is significant all over the continents, okay? Families are basically the rule of the game. Okay, so let me show you this. So this is the paper that I sent you to read yesterday, which you read, right? Which paper did I send you to read? I guess you didn't read it, okay? It's called Corporate Governance and Corporate Ownership Around the World, okay? And this is kind of like a very important paper for your case in some sense, okay? So what the paper does is the following, okay? The paper goes and says, we're going to start by looking at the ownership firms across countries, okay? So we're going to concentrate on the largest 30 markets in the world, okay? The richest economies, okay? And we're going to look at the largest firms, and then we're going to have a subsample of medium firms. Why the richest and the largest? Because if you're looking for firms like this, for widely held firms, these are the likely targets, because in the richer countries, there is more wealth means more people in the stock market, and therefore more investors, so they're going to look more widely held. Do you agree? Okay, fine. Now, why the largest firm? Because the largest firms are also more likely to be widely held because they're very big, so they require a lot of capital, so they're more likely to have dispersed capital. Does that make sense? Fine. So you pick the sample that gives barely and means the biggest chance of succeeding, okay? So this is the sample where barely and means should have 100% of widely held firms, correct? Mm-hmm. The largest countries, the largest markets, the largest firms, okay? It's like the cream of the cream, okay? Clear? Mm-hmm. Fine. So we're gonna look at them, and then we're gonna measure ownership. But we're not gonna measure just first year ownership like this, okay? This is what's called first year. We're gonna measure ultimate ownership. So imagine that here I find a company Z, okay? There's no Paul. So I need to know who owns Z, okay? And imagine that this is owned by company Y and it's owned by company X. So I need to know who owns Y, okay? So then so then you need to go down until you find Paul, okay? So this is what is called ultimate ownership, okay? So which is a lot more difficult than what Berlin Means did 100 years ago, okay? So now we need to look for the humans, okay? And we need to make sure that the humans own control of each level. So we're gonna say that you control this level if you have 20% of the votes. That's enough for a large company. So if you control 20% of Y, you probably control it. If you own 20% of Y, you probably control it, of Z, and so on and so forth. So we're going to say that Paul controls F if he owns a chain of control of 20 each. You can have a chain of control of 20 or 10, 50, whatever you want. Okay? Is that clear? Mm-hmm. Yes or no? So that's what they do. So they're going to make a map of the world. So now we're going to make a map of these 30 countries, 30 firms. So 20 of the largest ones, the largest 20, and 10 middle size to compare. Mm-hmm. Okay? So there's 900 graphs, okay, where you need to find all of the ownership. So there's going to be 30 per country, okay? So this is one country. So this is Microsoft, okay, in the United States, which is thought to be a widely held country, right? So Microsoft, top 4, okay? Who owns Microsoft? There's, Bill, Paul, and Stevie. Okay? So now, if you look at that, Bill, and Melinda, of course, okay, they have been the chairman and the CEO. They only have 23%, so with 20% they control it, clear, right? And if you put Paul, Steve, and Bill, basically own 40% of the firm. Okay? So is this a widely held firm? No. This is a family-owned firm, and it's called the Bill and Melinda Gates firm. Okay? So this is called a family firm. At a 20% chain of control, it's a family firm. At a 10% chain of control, it's a family firm. Okay? Is that clear? Now, if everything looked like this in the world, then Burley and Means would have gotten everything right. But the world looks more like this. Okay? So this is Samsung Electronics, like something in your case. Okay? Look at how this is held. Okay? So there is Samsung Electronics, then there is Cherjedan, blah, 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 Samsung Cup, blah, blah, blah. Lee Kun-hee is here with 8%. Okay? So he directly owns only 8%. He doesn't control 20. But then, if you look at Samsung Life, he's here, and then he's here, and he's everywhere. Okay? So now when you put it all together, okay, we would say Lee Kun-hee never has more than 20% of the chain. So it's a widely held firm. But is it really a widely held firm? No. Okay? But we're going to give it as a present to Burley and Means. So here's the present for Burley and Means. Okay? Take it as a widely held firm. Okay? But at 10%, yes, it is. Okay? Fine. Now, in fact, there's even more complications in the whole thing because there's webs of firms owning each other. So this is the number one, the top Belgian firm. And you can see here, so this is Electraweb, which is owned by this one, which is owned by this one. And of course, they have cross ownership, so the little blue things are cross ownerships, each one owning each other. Okay? And then it's owned by this one, and then this one, and this one, and this one. And finally, we find Suez here. There's Suez here. There is Suez somewhere around there. Actually, if you click here, there's a full graph that comes out, okay, with another web. And if you click here, there's another graph, and so on and so forth. So in order to find the to find the controlling group, you need to go really deep. So imagine doing, 900 of these graphs. It was like years of work, okay? So now you have this graph, and I'm going to make you one graph that summarizes two graphs that summarize the 900 graphs, okay? So here's the summary. It's like, let's go to the top, the creamiest firms, the ones that are the largest firms in the richest countries, where Burley and Means would have predicted widely held for sure. Well, in this state, there's only 1 out of 3 that is widely held. The other ones are family-owned, state-controlled, or they're controlled by other kind of corporation. So, in the biggest sample where you would expect Burley and Means to succeed, okay, these guys get, 3 out of 10 firms right. So the other 7, okay, they're different animals. So you're thinking that you have a zoo full of horses. So you have 10 horses, but in fact, you have 3 horses and 7 elephants, okay? Which is a very different animal. Now let's take the middle size of the market, just the average firm in the market. So here you see that only 1 in 5 is widely held. So you had, you had 10, you thought you had 10 horses and you're feeding the horse medicine, but in fact, it's 8 elephants and 2 horses, okay? So you can give horse medicine to the elephant, it's gonna do nothing, okay? Because the elephant is a completely different structure, okay? So this is the importance of this, that all these governance mechanisms that we were thinking about in the early generation don't apply or they're not gonna be very effective because this is a different animal, okay? Is that clear? So pattern number 1 is firms have owners, okay? An average firm have owners and they don't look widely held, okay? We have elephants in the zoo, we don't have horses, okay? Is that clear? So that's fact number 1. Fact number 2 is going to be, who controls these firms? Is it the large shareholder is different than the manager or not, okay? Well, let me just show you some more statistics. So people have then done more studies, okay? So this is another way of putting this together. So people have said, let's look at the block that controls the average firm in the country. So this is the aggregate block ownership in terms of percentage, and this is the proportion of firms that have this block owner. So you can see that the proportion of firms with a large block owner is almost 90% and above. So 90% of the firms have a large block shareholder. And this block shareholder has about 30 to 40% of the firms. So even in the US, 95% of the firms in the market have a large shareholder. Okay? In some countries, it's like 100%. Okay? So they have owners. Here's the last paper that I published. It's just a couple of years ago. This is from 2020. Okay? So the first data is from 2000. This is 2020. Now we do a lot of things, many more countries, and the ownership is more clear. So you can see that this is the what earth is this? This is the percentage share of control firms around the world. Okay, you can see that we're talking about, even in these other countries, we're talking about 50%, 60, 70, 80, or 100%. Okay, 80%. This is the amount of family firms owned, and this is the amount of state-controlled owned firms. But state is the same as a family; it's a large shareholder. Okay, is that clear? So the world is owned by someone. Okay, or firms are owned by someone. That's fact one. Mysteriously enough, as this paper says, guess where there are more family-controlled firms? In similar countries which have low K. So remember that I said that ownership is endogenous? So ownership is endogenous, so that's why our mechanism of managerial ownership is bogus. Okay? Because ownership responds to K. So you can see here how common law is the one that has more widely held firms, while similar countries, and in particular the French, seem to be the worst. Okay? You can run regressions of these and so on and so forth. That was fact one. Can I steal 5 minutes from you and then I'll finish this handout? Okay?
Yep.
So I will steal 5 minutes, okay? So I have 7 left. Okay? Do I? Yes, more or less that. Yes, definitely. 7.
Yes, sir.
Okay. So fact number 2. Is it the case that the large shareholder is the manager, or are they different? Okay? So then we're going to look at the firms that are family controlled, and we're going to see who is the manager. Okay? So this is from the original paper, the one that you never read. Okay? And this one says, okay, let's take the family firms. This is the proportion of family firms in the sample. Okay, so you can see, for example, let's make fun of Mexico. The largest 20 firms in Mexico, 100% of them are family owned. Okay? So what percentage of these firms are family run? In Mexico, 95%. So all except one, which is run by the son-in-law, okay? All they are family run. This is the largest companies, okay? The largest companies in the market. So you can see that 70% of the firms in the world, of the largest firms in the world, are run by the same guy, okay? So this key is not going to be a challenge for that one. They're the same, correct? So that is again another piece of medicine. This is a very different animal, okay? So the large shareholder being the solution to the agency problem, nobody, it's he is the problem, okay, or she is the problem, okay? Does that make sense? Okay, last fact, third fact, okay? How do they control them? And this is what's going to become something very interesting, and this is going to be useful for your case, okay? How do these families control the firms? Do they pay for all the shares, or do they control them through mechanisms that allow them to put less money and keep control? Okay? Well, it's going to be the second one. Okay? So there are several mechanisms of deviations of one share, one vote. Okay? So normally, if you're in a democracy, when you vote, okay, it's like one share, one vote, one head, one vote, right? So this is what is called one share, one vote, okay? So a good investor protection mechanism is one share, one vote, because if I pay for one, I vote one, okay? Now, there is something that is called deviation of the one share, one vote rule, okay? So one of them is going to be multiple voting, okay? So multiple votes.
One share, two votes, something like that.
One share 2 votes, one share 10 votes, one share 100 votes. Okay? So there's firms about that. Okay? Another mechanism of deviation of one share, 1 vote is going to be when I have cross shareholding. Okay? Cross shareholdings.
Like I vote for me and for the firm that I own.
No, like you have, imagine I have 3 firms, okay? There are 3 firms, and each one of these 3 firms owns 20% of the other one. Back and forth, okay? Now, so I have cross ownership. So now if someone wants to come from outside and challenge this ownership, he's never gonna win because, you know, the group owns the shares. So cross ownerships are some kind of deviation because the votes are kind of like bought. Okay? And the third one, which is the one that I'm going to show you something that's called pyramids. Okay? So that's a pyramid. Okay? And this is the most common animal in the zoo. Okay? So the most common animal in the zoo is an elephant with a pyramid. Okay? So what does a pyramid look like? Okay, this is a pyramid, you see, like in Egypt. Okay? So you have a pyramid here. So this is very different than, there's something that's called a horizontal entrepreneur. This is a pyramidal entrepreneur. Horizontal entrepreneur would be something like, here is Paul, and he owns firm A, B, C, and D. Okay? Now, a pyramidal entrepreneur, okay, here's Paul, he owns 1.1, and 1.1 owns 2.1 and 2.2, and 2.2 owns 3.3 and 3.4. Okay, and the same goes here. So that's a pyramid. Is that clear? Now, why would Paul do this? Okay? Why would Paul like to do this thing? Well, because he's going to deviate from one share, one vote. Okay? So let me show you some pyramid. Okay? So this is a pyramid in Hong Kong. So this is the top 3 firm. It's a pyramid from the Likashin. Okay? So this is the firm that is listed, Hachin Huwampoa. Here's him managing the firm. Then he owns Chen Kung Holdings, who owns 49% of this. And then the Lee family owns 35% of this. So this is a simple pyramid, just one chain, but it's a pyramid. So I control this node, and then this controls this node. Okay? So that's a pyramid.
Mm-hmm.
So Hong Kong guys know how to do pyramids. You know, mainland China guys also know how to do pyramids. Very quickly they learned. Okay? This is a Chinese pyramid, right? Mainland China, Chinese pyramid, so you can see it goes through. Okay? Fine. So good habits, you know, get picked up by the market very quickly. Okay? So let's see what the problem with pyramids would be, and I'm going to close a little bit with this in 3 minutes. Okay? So here is a pyramid. Okay? This is a pyramid by a family that is called the Ayala family, a very nice family to marry into. Okay? So Mr. Ayala, if you ask him, why on earth are you doing this pyramid? Okay? He will tell you the reason why I do the pyramid is because I'm a great manager. Everybody loves me, but I have limited capital. So I spread my capital around, and then all of these companies where I touch them, they're gold. Okay? And everybody likes my gold, my Midas touch. Okay? He will tell you it's because he has limited capital, but his control is amazing. Okay? Fine. Okay, let's see what he means by that. So let's see, here's the Ayala family. Okay, let's see how they control automated electronics. Okay, so the Ayala family owns 100% of ownership means shares, and C means votes. It's like one share, one vote that we have there. It's shares and votes. So they own 100% of Mermac, which owns 58% of Ayala, so they still control Ayala Corp, which owns, 74% of microelectronics, which owns 78% of shares and 90% of the vote of Assembled Inc., which owns 30% of Assembled Electronics. Okay? So that's how he does it. And then there's a couple of guys There are other investors, the Japanese technology and so on and so forth. Okay? Now, do we agree that he controls it? The family controls it, controls every node.
Mm-hmm.
How much money did he put in here?
Not much.
Not much, that's a good answer. Can we be a bit more precise?
Well, let's start dividing.
Divided or multiplying?
Multiplying, yeah, but 0.5.
Multiplying percentage.
Okay, so I'm gonna multiply 100% times 58 times 74% times 78% times 30%, it equals 10%. So the guy controls the company and he only put 1/10 of the capital. That's a deviation for 1 share, 1 vote. Okay?
Yeah. He has like a son company and grandson company, but like son company has the share of the grandson company. It's like
That's
that.
another thing. So that's a little bit more like cross ownership. Okay,
Yeah,
so
yeah.
the companies own each other. This is I'm just putting less capital every node, and then we get to this one. So there's a daughter company, and another company, and a daughter company. Okay. That's
Yeah.
Is this clear?
Is ownership and C equal again?
So ownership means in this graph, so that's how they put it. Okay. So
Deviation.
shares means ownership. Okay. It's the shares that go, and then when you vote, equals control. Okay. So this is O and C, but we can call it 1 share, 1 vote. The SH and V. Okay. Now, okay. So this is the example of 10%. Okay. Now, what's the problem with this? Okay. You can believe Mr. Ayala when he says that he's a great manager and that's why he controls it this way. Another theory is about taxes and hiding. So this may be a way to hide on all of that. Okay. All of that is very good, but what's the problem for the shareholders? Okay, for the minority shareholders. So here's the problem. Imagine that I have Mr. Ayala here, and he owns 50% of the firm A, and 50% which owns 50 of B, which owns 50 of C and 50 of D. Okay? Now, okay, imagine that D has a fantastic year. Okay? It makes a lot of profits and is willing to pay 100 million in dividends. Okay? How much is Mr. Ayala gonna put in his pocket? Company has wants to pay 100 million in dividends.
6.25.
6.25. Because he puts 50 here, 25,
Yeah, just
12 and a half,
yeah.
625.
times.
So imagine you get home and then you say, honey, okay, we had a fantastic year, but there is 100 million in profits, here is 6. Okay? You will be kicked out of your house. Okay? Because it's what are you talking about? We had 100, you come home with 6. Go do some self-dealing. Okay? And that's what it does. Okay? So this is the problem here is that the dividend channel is very onerous. So this pushes you towards the towards the self-dealing channel. So your pocket, and you go and say, well, 6 in dividends, let's go and do some self-dealing. Okay? I'm going to finish with these 2 graphs. I promise I stole 10, not 5. So this is another fantastic paper if you're reading this, which is called ferreting out tunneling. Okay, so what these guys did, okay, is these guys went to India where there's a lot of groups or pyramids. Okay? So they go to India and they have group companies, okay? I always love this thing about this one. Okay? So there are group companies which are, they're all in a group, okay? Okay, and then there's a pyramid seated, or there are standalone companies, okay? Standalone. And this is a group. Okay? Fine. So then they classified companies as belonging to a group or standalone. And then they're going to do this test that I just did here. Imagine there's a shock which produces 100 million more for every firm. Okay? So the shock that they use is India is an oil importer. Okay? So when the price of oil goes down, every firm benefits. It's an exogenous shock on the price of oil. Everybody benefits, costs go down. So profits go up. Okay? So that's the shock that they put in, which is exogenous to India and exogenous to the firms. Okay? So it deals with endogeneity. And then they're going to test two things. First, they're going to see if group firms, okay, underreact to the shock to their own profits. Okay? So if profits go up, you would expect a positive reaction, right? If they see that these firms react more than those ones, okay? That's the first thing they're going to test, okay? And this is what they find, okay? I'm going to concentrate on the first, on the first regression, okay? So they run, so they have 18,000 firms, okay, run here, okay? The sample size is 3 years because they have a couple of rough shocks. And then imagine there is a 1 rupee shock to profits. So profits go up by 1 rupee, so they standardize it to 1 rupee. So this is the sensitivity to your shock in group versus standalone firms. So the dependent variable is profits before, the deductions of interest and depreciation, interest, and taxes. Okay. So this is the profits they report. Okay. Remember, everybody gets shocked with a positive surprise. So everybody should report more profits. Okay. Yes or no?
The dependent variable is profit.
Profits.
Okay.
The dependent variable is profits before the depreciation and so on. After the shock. So you can see that, yes, indeed, when there's a 1 rupee shock, companies report 1 rupee more. Okay? But if you belong to the group, you don't report 1 rupee more, you report 1 rupee minus 30. So you report 0.75. Okay? The firms that belong to the group report 0.75. The firms that are alone report 1. So what happened to the 30? They put it in their pocket. Self-dealing. Okay? Isn't that great? Isn't that a great scenario? It's just like, that's why it's called ferreting out tunneling. Okay?
Tunneling.
That's only for India.
This is where had all of this data. Okay? So I haven't seen other countries do this, but I'm sure that there's papers and there's room for that. Okay? So if you have some of that. Okay? So this is like the original basis, like the first idea that came up. Okay, now they're going to also test, and I'll finish with this, they're going to test with this other one, okay? They're going to test its tunneling is more extreme in companies that are farther away from the owner. So in this case, where are you going to do more tunneling? From company A or from company D?
From company D, because you're getting less dividends.
Because you get less dividends. So they're going to see if the ownership impacts that. And that's exactly what they find. So this graph 2. First they find 2 things, okay? So let's concentrate in regression 1 and 3, okay? This is the 1 rupee shock in a standalone firm is 1 rupee, like we saw in the previous regression, right? 1 rupee. Now this is just for standalone firms, so it's 1 rupee. And in the group firms, it's 0.70 of a rupee, like we saw, they pocket 30 cents, okay? And now here's the second effect. In the second effect is a 1 rupee shock, okay, a rupee shock. If you own more equity directly, you leave more of the rupee. So you leave more rupees in there. So for each 1 percentage point increase that you own, increases the sensitivity by 0.03 of a rupee. So the closer it is to you, the more you leave in. Okay? Does that make sense?
The more cash you leave.
I'm sorry?
The more cash you leave there to.
The more profits you report. Okay? The less you self-deal. Okay. So let me conclude, okay? The 300-page handout, okay? So, where are we in corporate governance, okay? So, the separation of ownership and control is good when it brings problems, okay? And people have a lot of ways in which they can eat the pepperoni, okay? So we saw all of the different ways of eating the pepperoni, okay? We saw the mechanisms of control. We saw that law and regulation is the most successful one, but it's not perfect, okay? Sometimes the law can address things, but sometimes courts cannot do everything, like we saw. There are other tools for addressing opportunistic behavior, like leverage, maybe dividends, maybe boards, all of that, but they're kind of limited, as we saw. And the one that seems not to be a tool at all is the large shareholder, because the large shareholder is actually the organizer of the whole thing, okay? So people thought that it was a solution to the agency problem, but maybe he is the agency problem. himself, okay? And the Samson case is a little bit more something that basically tries to illustrate all of that stuff and how difficult it is to deal with, okay? Any questions? Of course not, everybody's exhausted, okay? So that sounds good. So when you come back, I'm gonna do, so you need to read, check if it's already there, a Nelson Paper Products case. Do we have the Nelson Paper Products case already showing up? Check if you're ready. If not, just send me an email and I'll put the Nelson Paper Products out.
Okay.
I think it's there. Nelson Paper Products. It's the case.
Nelson
And
paper.
that's going to be, we're going to talk about valuation tomorrow. We're going to do all the mechanisms for valuations in one handout. Okay? Is it there in the space for that or not?
It's topic 5. It's the last topic.
No. It's called Nelson Paper Products. Okay? Is it in the webpage or not? Okay, see you on Thursday, guys.
Okay.
Read the case. Read the case. If you don't read the case, you're gonna be completely lost.
Okay.
No, the Nelson paper.
Nelson Paper Products. Okay, I'm gonna send you the case.
Okay.
And I'm gonna ask you to deal with a couple of questions on the case. Okay, so you come with some ideas.
Okay.
Porque no está. Luego creo que
Tú sí tienes que hacer de ¿Alguna pregunta?
está en el último piso. La B1 es el que está todo. Estas son las cosas que están haciendo. No sé si es la de la derecha o la de la izquierda. Pero
La que está justo debajo de esta.
C1. No.
Okay. Bye.
Vale.
Sí, es la B. ¿Tienes clase todavía? Oh, la que me dice a mí. ¿No? Economic trends.
Monsieur, I want to make sure is that your email is from here.
So let me give you my email. Well, that's my email in my school. Okay.
Okay.
But my best email is
Okay.
my Gmail. Did I give you Gmail in the
No, you
in the
haven't.
syllabus? There's Gmail.
Yeah.
It's in the syllabus.
Okay. Great. That's nice.